Inducement is a price level where retail traders are convinced to enter positions at the wrong time, in the wrong direction, and at the wrong levels. What appears to them as a perfect trading opportunity is, in reality, a deliberate smart money trap designed to attract retail participation and capture their liquidity. In this video, we're going to break down inducement, what it is, the logic behind its formation, how to correctly identify valid inducement levels, and most importantly, how to avoid the common mistakes that trap most retail traders. If you're interested in learning advanced trading concepts, powerful entry techniques, smart money strategies, and how to master your trading psychology so you can stay disciplined throughout your journey, make sure to hit the like button to show your support and subscribe to the channel if you're new here. Inducement is one of the core principles of smart money trading and plays a major role in understanding how institutions engineer price movements. At its simplest, inducement refers to the first minor pullback that forms right after a valid break of structure. This pullback can appear in several forms. It might be a single candle, a cluster of candles, or even just a deep wick. Regardless of how it looks, its purpose remains the same: to lure retail traders into premature entries. These small reactions are convincing enough to make traders believe that price is offering a perfect early entry opportunity. But in reality, this is the zone where retail traders get trapped and where institutional players absorb liquidity to fuel the next move. Inducement is important because it highlights the exact points where retail traders commit mistakes. These internal pullbacks are designed to collect liquidity that smart money needs before pushing price toward its true target. Recognizing inducement helps traders understand not just where the market is likely to go, but also why price behaves the way it does around structure breaks. The concept of inducement is deeply connected to the smart money framework known as the power of three: accumulation, manipulation, and distribution. The process begins with accumulation, where the market consolidates and builds liquidity on both sides. This phase often appears sideways or choppy, but underneath the surface, institutions are gathering orders and preparing for a larger move. Next comes manipulation, the most critical part of the cycle. Here, price briefly moves in the opposite direction of the intended trend. This sudden push triggers stop losses, activates pending breakout orders, and forces retail traders into emotional decisions. All of this creates fresh liquidity, exactly what institutions require to fill their large positions. This manipulation often takes the form of inducements. Once positions are filled, the market transitions into distribution, where price begins moving in the intended direction with strength and efficiency. Institutions gradually unload or distribute their positions while retail traders, who were induced into the wrong side of the market, continue to get trapped. The entire cycle, the trap, the liquidity grab, and the decisive move, is what makes inducement such a powerful concept. It acts as the bridge between manipulation and the true institutional trend. Mastering inducement gives traders the ability to see where retail traders are being set up and where smart money is preparing to strike next. Although inducement is generally seen as the first pullback after a break of structure, marking it correctly requires strict rules. Let's explore several scenarios to understand this more clearly. First, consider a situation where price breaks above a previous higher high but fails to close above it. Even though the wick may pass the level, this is not a valid break of structure. Because the break is not confirmed with a close, we cannot mark any inducement yet. A valid break of structure only occurs when price breaks and closes beyond the previous high. Once this happens and price forms a minor pullback, the low of that pullback becomes the inducement level. Traders usually mark this with IDM or a dollar sign. In another scenario, suppose price creates a valid break of structure but does not form any pullbacks afterward. However, right before the break, price formed a small pullback. In this case, the minor pullback below the break of structure is treated as the inducement level, because it is the nearest internal pullback connected to the structure shift. A third scenario occurs when price neither forms a pullback before, nor after the break of structure. Instead, price moves in a corrective manner, showing a deeper or more gradual retracement. When this happens, we consider the low of the last major pullback as the inducement level, because that is where retail liquidity is resting. Finally, consider a situation where price forms a minor pullback after a valid break of structure but does not return to grab liquidity. Instead, price continues higher and forms another minor pullback. In this case, we must shift our inducement level to the most recently formed pullback. If price continues climbing and creates even more internal pullbacks, we continue shifting the inducement level upward. The inducement level is always the most recent minor pullback that price has not yet revisited. The key point to remember is this: we only expect a trade or confirmation once price returns to grab liquidity below the inducement level. Until that liquidity is taken, inducement remains active and should be monitored closely. Trades should only be taken from a point of interest, such as an order block, imbalance, or liquidity zone, once inducement has been swept. One of the biggest and most common mistakes traders make is marking inducement on a corrective move. This is not correct. Inducement should always be identified on the impulsive move, the move responsible for breaking structure. Corrective phases are slow, overlapping, and lack institutional strength, so marking inducement there leads to inaccurate analysis and poor entries. The only exception to this rule is when the market forms a valid change of character, also known as a chalk. This happens when a corrective move transforms into the first impulsive leg of a new counter-trend. For example, if price breaks and closes below a previous higher low, this confirms a change of character. In this situation, the corrective move has now become the new impulsive leg of the reversal. Therefore, we seek inducement within the price action that caused this new break, not the original trend. Understanding this exception is crucial, because it prevents traders from marking inducements prematurely or incorrectly. By focusing only on impulsive moves and confirmed structure shifts, traders can identify true inducement levels with accuracy and confidence. That's it. If you found this video helpful, don't forget to like, subscribe, and hit that bell icon so you never miss our next video. If you have any question, drop it in the comment below. Thanks for watching, see you in the next video.